Alrighty, can everyone hear me? Put a 1 in the chat there if you guys can hear me okay. Test, test, test. Looks like everything is working okay. All right, fantastic. Well, welcome everyone to this week's Sunday macro wrap up for Sunday, July 13th. We have a more action-packed week coming up this week in terms of macro data. Last week was pretty quiet. There were still some developments. Obviously, there was a lot that had to do towards the end of the week with a lot of interesting developments with the current administration in terms of tariffs. It seems like Trump is now ramping up the tariffs, and so that's definitely going to be, part of the headlines heading into this week, as well as, of course, we have CPI on Tuesday, and then on Wednesday we have producer prices. And then we also have retail sales. And what else do we have here? Consumer sentiment on Friday, some housing data. There's a couple of Fed speeches. So, as well as earnings season is starting up, right? So the earnings season for Q2 is being reported. And so we're going to be getting some of those numbers for some different banks in the financial sector, such as JP Morgan, Goldman Sachs, Bank of America, Citi, Wells Fargo, BlackRock, Morgan Stanley. We also have some tech and semiconductor manufacturers reporting, such as TSMC and ASML. And then in terms of the consumer/defensive, we have Netflix, Johnson & Johnson, PepsiCo, and 3M. Earnings season is starting to ramp up here. And what's really interesting in terms of like what I'm going to be looking for is any type of new data from more of the consumer side, right? Because a lot of the different consumer leading indicators from both the manufacturing as well as services PMIs have been showing that consumption has been really dropping off. And since consumption makes up nearly 60% of the GDP number, and then within consumption, 70% of that, 70% of the 60% is from services. And that has been slowing down. And so, part of what I've been talking about in terms of if we want to see a large ramp up in, we're already seeing a large acceleration in terms of, stock prices. But if you want to see that being sustained, what you would want to see is an exit of this stagflationary environment, right? So you would want inflation to continue coming down, as well as you would want growth to start to show signs of recovery. And what's interesting is that the economic data that we're seeing really hasn't been showing that at all, right? In fact, in taking a look at some inflation nowcasts, such as the Cleveland Fed's inflation nowcast, you have them having CPI going from 2.4, right? Because right now the current inflation rate headline CPI is 2.4%. The Cleveland Fed has that going up to 2.64% for the month of May. For the month of June. And then for the month that we're in right now, July, they have it going up to 2.7. So Cleveland Fed has inflation, accelerating quite a lot. And then in terms of core CPI, that's going to remain around 3%, right? And so when we take a look at core CPI, right now that's around 2.8%, and it's had a pretty large drop off so far this year, right? So in January, it started off around 3.3%, and now it's all the way at 2.8, but they have it rebounding back up to 3.0. And so although that is, a lot lower from where it was a year ago, you have to remember that the consumer price index, it's an index. And the headline numbers that we see in the news, that is the year over year rate of change. And so if I go back to headline CPI, if I change this to just the normal index measure, this is what actual inflation is doing, right? So this is what people are experiencing. And so since 2020, that was around 258. That's what the index was there. And now we're at 320, right? So I don't have a calculator in front of me, so I don't know the percentage increase there. But, just take out a calculator and do the percentage increase from 258 to 320. That's the cumulative inflation. If someone in the comments wants to do that real quick, that's the cumulative inflation that we've been feeling for the past, 4.5 years. And so you have to think of it that way. And so the rate of inflation accelerating has just been coming down, not actual inflation in general. And so, that's what we're seeing here. Really, if you wanted to see prices come down, you would need to see deflation, which is when you see the rate of inflation actually go into the negatives, which in that case, that would be a clear sign of recession. But we aren't seeing that yet. A couple of other measures of inflation that I do like to look at that I don't hear too many people talking about. One is called the 16% trimmed mean consumer price index. Now, a lot of economists prefer this as a measure of inflation only because it's called 16% trimmed mean because it takes 8% on either side of the items that fluctuate and it essentially removes them. So it's more of a core measure. And that's right now at 2.2%, which is a lot closer than the pre-pandemic average. And then some of the other larger components, such as shelter, that remains at 3.9%, pretty close to the pre-pandemic levels, which was around like 3%, 3.1%. So that's getting more in line. We're seeing a lot of headlines right now, including in hot housing areas, such as where I live in South Florida. A lot of prices are actually coming down year over year. And so you're seeing a large exodus out of places like West South Florida, right? Like I think it's Cape Coral, where they're seeing like prices really come down because they've had a lot of issues with hurricanes in the past couple of years, and insurance is just out of control. Even where I live, it's out of control. So we're continuing to see housing inflation come down. In terms of services, that's continuing to come down as well. Not near pre-pandemic levels, but it's getting there. And then when we look at commodities, less food and energy, so this is core commodities. This is really what is driving the inflation reaccelerating right now, right? So over the past, pretty much year and a half, this has been accelerating and is now positive year over year. And so that, as well as the prices of oil and other commodities that we're seeing spike right now, right? So when we look at the CRB commodity index, this is showing that after that huge, drop back in April, this has pretty much rebounded to where it was, high. And so, if we see things like base metals, industrial metals, commodities in general start to rebound, those are inputs in the economy. And so we'll continue to see inflation remain sticky, right? Even if some of the other components are starting to come down, if, energy and others are going back up, right? There's a shift now, then you could really see a stagnation in progress on inflation. And that's really what the Fed is worried about, is a lot of these tariffs causing the input prices to go higher. And they're just not sure if that's going to cause some type of shock and make them look bad, like what happened in 2021. If you guys don't remember, in 2021, when they started to see inflation accelerate, they called it transitory, and then inflation got out of control, and they had to walk back on their word. And really big egg on their face. The analogy that I like to use there is, I don't know if you ever watched those old Tom and Jerry cartoons when Jerry would run into the rake and it would like smack him in the face. That's essentially what happened to the Fed, and they're really trying to avoid that right now. Um, so taking a look at some of the headlines here, I saw this Treasury post a surplus in June after tariff receipts, and there was some praise that was being, shown by tariffs. And although yes, there was a surplus, it's not something that for a 1 month surplus, it's not out of the ordinary, right? So if we take a look at this chart here that shows the monthly surpluses or deficits, you can see that it fluctuates pretty rapidly, right? So there was also a surplus, a way bigger one back in April. I didn't really hear too much news about that. There was also a surplus in September of 2024, April of 2024, August of 2023, April of 2023, April of 2022, and January of 2022. And it's pretty cyclical, right? So a lot of times in April, you'll have that spike there because why? Tax receipts, right? And that's essentially what you had here. So extend tax receipts, but they like to give all the credit to tariffs. But as you can see, it's highly cyclical. So I doubt that we'll see another surplus in the next coming months here. But just wanted to show that it's not that big of a deal. And then what else happened last week? Let's take a look at the target rate probabilities, right? So we have a Fed meeting coming up at the end of the month here. As of right now, there's a 95% chance that they're going to have rates remain where they're at and not paused. Pretty much you want to look at the months leading up, so, or the months after this one. So looking at the September Fed meeting, this is what's interesting, right? So with the data that's been coming in so far, the probabilities of a continued pause went from, let me see here. Yeah, 1 month ago it was at 28%. Now it's at 36%, right? And then just 2 weeks ago, it was around 8%. So it went from 8% all the way to 36. And then this went from, in the upper almost 70% down to 59.7%, right? And so if we continue to get data where, commodities and oil continue to accelerate off of easier comparisons compared to last year, then you could see rate cuts being priced out of September, which is, definitely a possibility here. I'm actually in the camp that, if the government keeps printing money, which is what they're doing with the massive, spending that's going on, as well as the Federal Reserve or the central banks, keep continuing doing what they're doing, which is, slow quantitative tightening. We're in a period right now where the government is really in control of any type of money printing. And, a lot of people are obsessed with what the Fed is doing, but you need to shift your focus off of the Fed and focus on what the government is doing, because, spending at 6 to 7% deficits during quote unquote peacetime, the last time that this happened was when we were in World War II. And so it's completely unsustainable. And there has to be a breaking point. Now, one of the big things that happened last week, which, I don't hear too many people talking about, was Fed Governor Chris Waller went on TV and gave a speech talking about the Federal Reserve's balance sheet. And what was interesting there is that, he talked about essentially the core setup that he sees right now. Essentially what he was talking about was the Fed's balance sheet is mostly made up of longer duration treasuries, and that having the composition of it like that instead of short duration really limits what they can do. And so, they're stuck essentially with a bunch of these treasury securities on their balance sheet. And so he essentially said that they're going to continue their quantitative tightening. And specifically, he was talking about reducing the amount of reserve balances from where it's at right now, which is around 3.3 trillion. So I'll go ahead and bring up the reserve balances here. Right, so this is bank reserves. Now, he was talking about bringing it down to around 2.7 trillion, which as of right now, that would be about an 18% decline from where they're at right now, which would have a pretty big impact, right? And so they're going to try and coordinate with the government in order to get that down. And that's pretty much the other reason why the government is spending so much money, because the Fed is trying to reduce their balance sheet. But if the government wasn't spending as much money as they were, then you would have a real big credit crunch, and the market would not like that at all, right? So whenever the Fed goes on TV and says that they're independent from the government, it's completely not true. They coordinate all the time. In fact, it's their job to coordinate and make sure that the markets don't implode. And so he was essentially describing this in accounting terms, but that's what their plan is right now, is to continue quantitative tightening and to try and shift the composition from long duration treasury securities to shorter duration, which means it's essentially the green light for the government to keep spending the way that it's spending. But it's not sustainable, right? Because if this keeps on happening, then the Fed can't cut rates. You're going to see the 10-year Treasury bond yields start to go higher. And ultimately, the amount of money that the government is spending on its on interest is going to keep going up, right? So it's essentially a very time-sensitive Band-Aid, and the Fed really needs to hurry up on getting their balance sheet down so that they can lower interest rates, and so the government doesn't keep on having to spend a crazy amount of money on interest payments, right? Interest payments are now exceeding the current spend on defense spending, which is not sustainable at all. I think the only thing more expensive than the government paying off its debt interest is Social Security, and yeah, so it's very expensive right now. Just to take a look at some of the charts here, you can go to the Peter G. Peterson Foundation. This website is really good. They always give monthly briefings as well as in-depth analysis of the deficit. So definitely, if you want like a breakdown of what they're spending on, all the increases, I would definitely recommend going to this website right here. Another one as well is, what is the national deficit? This is fiscaldata.treasury.gov. This is a government website. You can see that it's from this time last year. Deficit spending year over year is up 5%, and it continues to accelerate. And then when taking a look, this is another website, the bipartisanpolicy.org. They have a deficit tracker. And so when comparing 2025 to the previous 3 years, so you have 2024 here, 2023, as well as 2022, you can see that 2025 is on track to being even more of a spend than the previous 3 years. And, we've talked about before how the stock market is, directly correlated to how much the government is spending, which is why our team keeps saying like, hey, if government spending keeps on accelerating like this, there's not too much of a reason to be super bearish on the stock market. And, back in mid-May, when our model went bullish on the S&P 500, I saw a lot of the comment sections on my videos saying like, oh, this is just a dead cat bounce. We're going lower, doom and gloom. And, that's why it's important to just, pay attention to a model that you have that can just look at the numbers and just be, very unemotional, right? And so the model has been spot on since then. And, since mid-May, we've been getting new all-time highs, as you guys have been seeing. But getting back to this speech from last week, one of the big reasons why they're trying to hurry up is because the remittance payments from the Fed has been negative, right? So the Federal Reserve has been essentially at a loss, a huge loss for quite some time, ever since interest rates have been rising. So this is why they're trying to change their composition of their balance sheet, and they have to do that soon. Now, one of the reasons why we can definitively say that they are reducing assets off their balance sheet, because I saw some people on X, on Twitter, were saying how the Fed, they're doing QT, but then they're buying back a lot of those Treasury securities that they're letting roll off. That's not true at all. We can look at this chart right here, which shows that year over year, it's still negative, right? So the percentage increase, it's in the negative, which means that they're at net reducing their balance sheet, and that's pretty much been negative since December of 2024, and that's been decreasing since it peaked in May of 2024. So you can look at that to say that definitively, yes, they're reducing their balance sheet. And then one thing that I'm also looking at is the year-over-year rate of change in treasuries. So as you can see, this is continuing to, come down. And what that means is that, demand for treasuries is starting to flatline and actually go down. And so that's also putting pressure on yields to go back up. And so the government and the Fed are just on a timer right now, right? Which in turn means that this stock market rally, there is a timer on it as well. I don't know when, that timer is going to go off. I don't know at what magnitude will happen after that timer goes off, but just know that this is a temporary Band-Aid, and there will come a time to be more defensive. So that's, pretty much what I was looking at last week and what I'm looking at going into this week here. I think the big headline, or for me, the big signal was Bitcoin, right? So Bitcoin, huge acceleration. We've been talking about in our group how we've been seeing a consolidation of volume, and we just had a huge spike in volume here with price, which is a huge sign. Now, I was actually in the camp where I was thinking maybe that we could see it go lower, but it ended up being an acceleration with this move right here, and then it can just continues higher. So yeah, we're almost at 120K Bitcoin right now, and then you're also seeing accelerations in altcoins like Ethereum, as well as XRP. So those are the two ones that I'm looking at in terms of altcoins. We're not necessarily yet in an altcoin season, just because when you look at altcoin dominance, it continues to be in bearish trend, although we're having a little bit of a bounce here. We would definitely need to see some more work done, but you can find some altcoins that are doing well. For those that are in our partnership circle, you guys know which ones we are referring to. S&P 500, here's the SPY here. Ranges heading into Monday. Here are the range zones. Top end 630 to 628, low end 613, 614. It is closer to the top zone, so there is in terms of probabilities more downside versus upside, but it can still keep going higher. At some point it will correct, in which case that'll be providing a good buying opportunity. So either way, we'll just end up seeing what happens. All right. So the way that these Sunday macro wrap-ups work is, for those who are on the stream, from here, we're going to go into the second half of this stream, which is only for our Macro Optics members. If you guys would like more information about that, you can just go into the descriptions below. For those who are on Instagram, TikTok, or X, you can go to my profile page and check out the links that are there. But we're going to go ahead and transition here. So I hope everyone has a great rest of your Sunday night. For those who are on the Zoom call, stick around. And yeah, we will catch you guys next Sunday. Bye, everyone.